Everyday chat and chart live during the New York session. Here, real traders share the raw truth, their mindset, technical analysis, and execution. This is where real traders show their skill set. Welcome to Tradin TV. This is your stage to shine.
Hello, hello. Good morning, everyone. Can everyone hear me? Okay. All right. So good morning, everyone, and welcome to a new episode of Chat and Chart. Today we will be going through the economic calendar, the weekly high impact news calendar, and then we'll move to the charts and see how the fundamentals align with the technicals so that we have an edge over the markets and over other market participants. So without further ado, let's get to it. All right, we start with Monday. So guys, on Monday, we have 3 data points coming from the US. We have the S&P Global Manufacturing PMI, we have the ISM Manufacturing Prices, and the ISM Manufacturing PMI. So as for the S&P Global Manufacturing PMI, it is expected to improve slightly. So 0.1 point from 51.8 to 51.9. If it comes in higher, that's obviously more positive. But if it doesn't, if it comes in slightly lower, but still above 50, it's also positive, but less positive than if it comes higher. Okay, so anything above 50, we are in the expansion territory, and it's healthy for the US economy and for the manufacturing sector. Now I have to stop for a second to just discuss gold and silver, because like in the past, I don't know, like 15 minutes, we went up more than $100 on gold, and how much on silver? $6, $7 on silver. So I think we're somehow preparing to reverse from here, but let's wait till the analysis or till we move to the charts and discuss those, because it's very dangerous to catch a falling knife. But there will be, as being the voting was still pending, leading to the government shutdown. Okay, we'll discuss all of this, but first of all, let's finish the economic calendar. So next, we'll move quickly. ISM manufacturing prices, it is expected to be higher, slightly higher, which is bad for inflation and good for the US dollar, because it means that rates will be higher for longer. And we have the ISM manufacturing PMI. So it was negative at 47.9, so below 50. So in the contraction territory, it's contracting. The forecast is 48.5, so it's expected to improve, but still bad because it's in the contraction territory. It's below 50. All right, so that's it for Monday. We move now to Tuesday. We'll have only one data point, which is the job openings coming from the US. The previous was 7.146. The forecast is 7.210. So it is expected to improve and like improve pretty well. So if it comes in higher, it means positive or resilient jobs market. If the jobs market is resilient, they can keep rates higher for longer without any problems, without harming the jobs market or the people or in the labor force. Okay, so let's wait and see. Then we move to Wednesday. Wednesday is a big day, February 4th. So we have the CPI coming from the Eurozone. But the previous was 1.9%. The forecast is 1.8%. So inflation is expected to even go lower in Eurozone, but that's not always good news that inflation is going down, because there might be a risk of something we call deflation, which is the exact opposite of inflation. You might say, okay, so lower prices, why Why are we sad about that, or why isn't it a positive thing? Because too low prices mean lower profit margins for companies, and lower, if like, why buy something that costs you 10 today while you can wait for tomorrow and you buy it for $8 or €8, for example. So people stop buying, they stop moving the economy, and the profit margins of businesses get squeezed, and then we have layoffs, and the jobs market get harmed by this. Okay, so I think we will be seeing the ECB cutting rates this week. Let's see. Now we have like, next we'll see the ECB expectations, or the interest rate decision expectations. But for now, it is expected to be lower. If it comes in lower, it means that the ECB on Thursday will have to cut rates to actually boost the economy and stop it from deflating, which is the opposite of inflating. Okay. Now, the ADP non-farm employment change, that's in the US, that's for the month of January. The previous was 41,000. The forecast is 48,000. So that's an increase, that's an improvement. But let's see if that actually is the case by then. If the actual comes in higher, then that's positive. Higher or as expected, it would be positive. If it comes in any lower, it might be negative for the jobs market, okay? And will put pressure on the Fed to cut rates. Now, next we have the S&P Global Services PMI. We saw the global manufacturing PMI on previous slide, which was Monday. Now we have the global services PMI. The previous was 52.5, so it's expanding. It's above 50. The forecast is no change at 52.5, so it will be expanding at the same trajectory or the same pace, if you like. So ISM non-manufacturing prices and ISM non-manufacturing PMI. Now, the non-manufacturing PMI was 53.8, and it is expected to not change. 53.8. Any higher readings would be positive. Any lower readings would be negative. But it's still above 50, so we're in the expanding territory. Now, the prices were 65.1. If it comes in higher, it means that the non-manufacturing prices are going up. So meaning that this might reflect to inflation, and we'll get higher inflation readings in the future. If not, we'll just it will mean like if it comes in lower than this, we might see a better reading or a lower reading in inflation in the following months. Now, lastly, we have the crude oil inventories on Wednesday, and the previous was a shortage of minus 2.29, almost 2.3 million barrels. If it comes in above zero, it means that demand is not keeping up with supply, supply is not keeping up with demand. And what did I say? No. If it comes in higher than zero, that's a surplus. It means that demand is not keeping up with supply. If it comes in even like a shortage, which is bigger than this shortage, like minus 4 million, for example, it means that supply is not keeping up with demand. Okay? Demand is much higher, and they're drawing a lot from the inventories. So for now, we'll have to wait and see. That's for Wednesday. Now let's move to Thursday. We have the Bank of England interest rate decision and the ECB interest rate decision. Both of them are expected to hold rates steady. So the Bank of England is 3.75%. The forecast is also 3.75%, meaning they are not expected to cut rates. But surprises might happen, although central banks usually don't surprise markets, because this will cause more volatility and more uncertainty. Okay, so central banks usually like to be predictable. Okay, so the euro deposit facility rate is 2%. The forecast is also 2%. And the interest rate decision is 2.15%. And the forecast is 2.15%. So no change from the ECB as well. But if we go back to Wednesday, we will see this number, which is the CPI. If the CPI comes in lower, if it comes in at 1.8% or even lower than this, we have a big chance that on Thursday, the ECB will cut rates, will actually cut rates. So let's wait and see. And if they cut rates, if they do cut rates, this would be negative for the euro because it's less attractive now for people to hold euro. They would exchange it for a higher yielding currency. Now, then we have the initial jobless claims. The previous reading was 209,000. The forecast is 213,000. So we'll have to wait and see. It is expected to be worse for the jobs market. So more people are claiming to be jobless or are expected to be claiming jobless than the previous reading. So we'll have to wait and see. If this comes in higher, it means negativity on the jobs market and the US dollar. If it comes in lower, it means that the Fed can hold rates higher for longer to control inflation. Okay, and then we have the ECB press conference, through which they will discuss everything that happened here, which is the facility rate and the interest rate decision. And we might get some hints and future guidance on the future of interest rates in the Eurozone. Okay. Finally, we have Friday. Big day on Friday. We have the famous non-farm payroll. We have the average hourly earnings, non-farm payrolls, and unemployment rate. Now, the average hourly earnings and the unemployment rate are expected to stay unchanged. So 0.3% average hourly earnings. In comparison to the previous, it's the exact same number. The unemployment rate is also expected to stay unchanged at 4.4%. Now, if this comes in higher, that would be very negative for the jobs market and the US dollar because it would mean that the Fed needs to cut rates to boost the economy and boost employment, which contradicts with their mandate of stable prices or price stability, which is controlling inflation. And we have the non-farm payroll. The previous reading was 50,000. The forecast was 67 or is 67,000. If it comes in higher, that's positive for the jobs market. If it comes in lower, that means negativity for the non-farm payrolls. All right, guys. So that's it for the economic calendar. Do you have any questions before we move to the charts? Hello, everyone. Hello, everyone. So Shishi, who's asking? Someone asked, what time is exactly London session? Okay, it starts in 2 minutes. So whatever the time you have, just add 2 minutes, and the London session starts in 2 minutes. Okay, Kevin Walsh, not Walsh, Mesa, but yes, that's a key factor in the drop we saw last week in gold and silver and the metals sector, market in general. Let's move to charts. No one has any questions. Okay, so let me stop this share and my screen share, and then let's start a new one. Guys, am I frozen? Am I moving or I'm frozen? My video is frozen, huh? Okay, so, but you can hear me well, yeah? Okay, so let me tell you a story now. Maybe it will work by itself, but can you see the chart moving? Okay, loud and clear, you can hear me, and can you see the chart moving? Do you see me moving on the chart? Okay, then no problem if I'm frozen. It'll work by itself. You don't need my face anyway. You need to listen to what I have to say. So now let's start with the dollar index as always. We start with the DXY. Now, if you look at the weekly chart, there was a big rejection from this level, which was a very important level. Um, that's the lowest level in, I think, um, 4 years. Yeah, was it 4 years? Yeah, it was the lowest in 4 years. So, but after we reached this point, we got rejected pretty bad. Now, the rejection was mainly because of something Mesa just mentioned, which is Kevin Warsh. Who is Kevin Warsh? Kevin Warsh is the guy that Trump nominated to be after Jerome Powell as a Fed chair. Okay, so this guy is known for his hawkishness. He is hawkish. Hawkish means that he's in favor of a stronger dollar. So after this announcement by Trump that he nominates Kevin Warsh as the new Fed chair, the markets started acting upon this piece of information. Okay, so we saw dollar picking up. So what happened when dollar picked up? Right before that, right before the dollar actually picked up and markets started buying the US dollar, we had gold at all-time highs and we had silver at all-time highs, platinum, and a lot more from the metals and other assets. Okay, so once that happened, markets or like investors started buying in USD, which pressured gold. It made the USD go up, which made gold and silver go down. All right. So after they went down, what happened there? What caused the meltdown? Now, at the beginning, the trigger was what? Kevin Warsh. After the dollar gained some strength, there was there were a lot of retail traders just jumping in, FOMO traders jumping in into the market, buying gold and silver blindly with like stops $100 below or $200 below, and just like gambling away. They were trying to buy at all-time highs, and we saw the volatility on like around the all-time highs. And last week I was on a TV interview where they asked me if I think there will be a drop in gold prices and silver prices, and I said, yeah, we might see $1,000 to $1,500 correction on gold, and people were actually laughing at what I said. Like if you go to the YouTube and you go check that clip, people in the comment section were laughing at me. So that's when I knew that this is very close and we're going to see a meltdown. So again, what happened there? A lot of people were buying blindly. So FOMO traders, retail traders, and we saw the volatility during that time. So once that dollar strengthened, gold and silver slightly went down, like $100 maybe. Okay, they went $100 down. What happened to all the people that bought with leverage on close to all-time highs? They got burned out. They got shaken out of the market. They got liquidated. Their trading accounts got liquidated. So what happened there was one stop loss got triggered after the other. So each stop loss, now like a stop loss of a buy is a sell, right? Now each stop loss got triggered and pushed price lower to the next stop loss and the next stop loss and the next liquidation of a trading account, and another margin call and another margin call, all at the same time. Plus there's another point of input that I haven't mentioned yet, which was like brokers and like big institutions were not happy with like very high leverage. So what they did, they increased the margin on gold and silver. So people who were like just trading normally started getting margin calls, and they did not meet those margin calls, so they did not like add more money to their accounts. So their accounts started to close automatically, and this automatic closing, which is like forcibly closed, they were closing automatically because they don't match the margin requirements. They started getting liquidated, and there was a domino effect that caused this bleeding in price. So anyone who was trying to buy with stops like even $100 away or $200 away was getting stopped out. So we saw this bleeding during um, Thursday and Friday. Okay. Yeah, but I'm telling you a story. You're telling me to zoom chart. I will once we start analyzing the chart, but now I'm telling you a story. So yes, exactly, Shishi. All right, now back to the charts. You understood the story and you understood why this rejection happened in the XY. Now, if you look at Euro, you will see the exact opposite rejection to the downside, right? Now, do we have a divergence? Yes, we do. We might be dropping from here, God knows, but let's now go back to the DXY chart and discuss more. Now, on the daily, it just hit the major uptrend line, which has been going for the past, I don't know, 18 years. Okay. So now we're at a point where dollar might reverse from here. Okay. That's a very important point. We need to pay close attention to that because it might reverse from this area. And if it does reverse from this area, it means more downside to everything else against the US dollar, especially Euro USD. Okay. Now we move to the 4 hours. Also, 4 hours is like showing some strength, but we're not actually strong unless we break 99.5. Okay. Like as long as we're below this, it's still in a downtrend, lower highs, lower lows. So nothing to rely on in our trading yet. Okay. So far, it's still trending downwards. If we bring this here, yeah, we might stop around this cluster of moving averages around 98.5. But if 98.5 gets broken and clears out the 99.5, we will see like a breakout to the upside, and we might see above 100 again, maybe soon this year. Okay. So that's for the XY. We're done with it. So there might be a rejection or a reversal in the downtrend. Now, let's take a look at the euro now here. Okay. So the euro looks like this. We have this bearish rejection. So I think for a fact, we are most likely moving to 1.1740, which is this level. Okay, we have to reach that level. We'll have to wait and see lower time frames to get more confirmations. Yeah, this might be it, but this cluster of moving averages might get actually tested. So 1 second, please. Yeah, we might test those around the 1.1740 area, and then we might continue going up. This is only if the uptrend remains intact. If not, if it does not remain intact, it means that the dollar is still going down and the Euro USD is still going up. So we'll have to wait and see. But this is actually a very good entry, to be honest. I would buy here with my stops below this, which is like 20 pips away. Nothing much. This was Was this a correction? Yeah, it was. So that's a good area to buy, to be honest. So meaning that the DXY might be uh, going down now. Okay. All right. We move now to okay, the 15-minute. Yeah, it's showing signs of strength. Now we move to GBP USD, which also like got rejected from the highs here last week. So I was waiting for this area to buy a GBP USD. It never reached there, or it didn't reach there yet. So we'll have to wait for that. Um, the daily, yeah, the daily looks good. Maybe it will retest this area, the breakout zone. It hasn't retested that zone ever since it broke above. So this zone might be a good place to buy, which is 1.3540. That's for this 4 hours. Okay, so now let me tell you the reason why other things, not only the gold and silver, went down. Let me read questions 1 second. But you're making sense for me, technical analysis, but I just know upper layer of technical analysis. This is German discussion, standing dollar rate unchanged, job claims improving. Okay, what time? The German discussion. Yeah. Okay, now can someone of like any one of you, can you know why other assets, like for example the Nasdaq or the stock indices in general, the crypto, why did they go down? Because like or after the gold meltdown. Does anyone know why? I'll give you a minute. I'll give you a minute to answer. If you watched Beyond the Charts on Funding Pips, you would know why. I explained it there. Okay, so why the sell-off in Bitcoin? And exactly, I explained yesterday in my video. Thank you, Mesa, for watching. Okay, so let me tell you what the reason was. So imagine you have a trading account, okay? And in that trading account, you hold different positions like Nasdaq, Bitcoin, gold, silver, whatever, okay? And this meltdown in gold and silver started happening. So your account has, for example, $1,000, but your loss on gold and silver was more than or almost $1,000. So what happens there? Your whole account gets liquidated. Like you get a margin call, and then they forcibly close your trades. Correct? So if you had Bitcoin and Nasdaq positions running, like buys, for example, because they were going up before the meltdown, your gold position might have liquidated the account while those trades were still on. So they closed them, forcibly closed them because like again, when you forcibly close a buy trade, that's a sell, correct? So that's why when the loss of gold and silver became too big, other things like Bitcoin and Nasdaq also got closed. Buys got closed by another sells. So this selling pressure caused them to also sell off at the same time. So do you see how the market is connected? It all happened because of the margin and the leverage trading, but that's just like to show you how the markets are connected. Now moving back to the charts to GBP USD. I will not be chasing, but only if it reaches this area, which is around 135, I will be considering a buy there. Yes, I will. Now, that's it for this. Let's take a look at USD JPY. We go to the daily. Okay, so we reached 159, almost 160, and then the intervention talks caused this drop. But again, we got rejected from an important point, which is 152. We might go lower to this area, which is 150. That would be a great buy, to be honest. But let's wait and see. Yeah, I think we're still like in a downtrend, lower highs, lower lows, unless we just like invalidate those and we close above those moving averages, which is above 156. All right, Bitcoin, real quick. Bitcoin is dropping like crazy. But why? The reason is, the main reason is the meltdown in metals. So panic selling took over and accounts got liquidated and leveraged positions were closing on Bitcoin. So we saw this meltdown. We need to wait and see if it's going to reject from this area because this is a very important area. But the area that I would be considering buying Bitcoin from would be the 71,000 or even better 60,000. I think 60 or $65,000 on Bitcoin were actually or was actually the halving price. So if we reach there, that would be the break-even price for Bitcoin or the fair value of Bitcoin. I would be buying Bitcoin happily around that area, which is the halving price. I think $65,000, or like a bit more, like give or take a couple of $1,000. Okay. Now we move to the big boss. We move to gold. So let's take a look at the monthly first because we need a big bias. So the monthly closed pretty bullish. Like even though all of this happened and we saw this meltdown, it managed to actually close higher. Okay. So the previous month's low was 4,300. So this might be our safety net, or like if it reaches near there, we might be buying with stops below this area. But it's still like falling, like that's a falling knife, so I wouldn't dare to do that. But in terms of the weekly, we already broke last week's low, which was the 4,700. And we reached today, this morning, we reached 4,400, which is like a very, very big drop. Now, from the highs, we're down $1,200. So 12,000 pips from the highs last week. So how many days did it take to drop to that area? 1, 2, and 3. 3 days were enough to wipe out $1,200 of gold price. Okay. So what's going to happen next? That's the $1,000,000 question. What's going to happen next? Now, as you can see on my chart, I have this level marked out, which is the trend line coinciding with the moving average, the 50-day moving average, which is a very important moving average. Now, if we close today below this moving average, we're moving down to the next one around 4,100. If that gets broken, and that's my ultimate entry, or like the ultimate price I would be very happy buying at would be $3,800 per ounce. So that would be, let me see here. So that would be after a $1,700 or almost $1,800 correction. That would be amazing. That would be a discounted price, and you can easily make money out of this. If it reaches here, you can buy with stops below this area. I know the stop is very far, but also the take profit or the target area would be huge. So it's worth it. It's definitely worth it. I would definitely buy if it reaches that area, and I might be buying very soon because this is a level where we are right now is actually a level. But we need to see positivity on higher time frames, because if you look at the 4 hours, it's very negative. All red candles or all bearish candles. So we don't need that stress yet. But here we have an engulfing candle at a very important level. So this might be the start of the correction, or not the correction, sorry, the start of the continuation. We had this engulfing candle, it closed here. Now we need to see price doing something like this. So we made this low, we wanted to break here, for example, and then try to make a new low and fail to make a new low and then go up. Okay, that would be our perfect scenario. But this might never happen. We might reach here and then continue dropping. So if we do that and you continue dropping, I recommend you not buy gold or sell gold, because at the moment it's very, very volatile. It's very aggressive. Like only in this candle alone, it went up more than $100 in this single candle. In the previous hourly candle, it went up more than $100. Like, let me just measure it for you. From less than 2 hours ago, an hour and 20 minutes, we're up to $140. That's a crazy move. That's very, very crazy. So you'll need to be very careful trading gold and silver, especially during this period, because the market is still cleaning out or like shaking out all the speculators, all the leverage traders, all the retail traders. Once you see it stabilize, you now know that the investors are in control, and they're actually, the market is driven by a reasonable behavior, which is the investor behavior, not the retail trader behavior or the speculator behavior. All right, because this volatility is mainly caused by psychological mess from the retail side. Okay, when you see FOMO, when you see like people jumping in blindly, that's FOMO. That's like mainly herd behavior and retail behavior. So we will need to wait and see. We want to think like institutions. And we want to make money and protect ourselves, because the number one priority now is to make or to preserve your capital so that you can use that capital to make money. Okay. How long will it take for gold to return to normal? It might like finish that seesaw today. We need to wait and see. But you'll be able to tell when it settles down. Like you will see like $50 moves a day, $20 moves a day, so on. But not $100 and $200 and $300 moves a day. All right. So that's basically it. I think that's it for today. I'm waiting for your questions. If you have any more questions, I'll stay for a couple of more minutes to get your questions. Okay, so massive loss, take away little profits. Exactly. Margin calls are like we see in movies. Exactly. Yes. These are non-yielding assets. Okay, dollar yields more as compared to others. Correct. Thank you for Bitcoin. Now I'm a bit happy. Glad you are. The Fed chairman, how long will it take for gold? We answered that. Thanks for the great sum ups. My pleasure, my friend. My pleasure. All right, guys. So I'll have to wish you a great trading week ahead. Good luck. Stay protected. Make sure that you preserve capital so that you can use that capital to make money. If you don't have capital, you cannot, or if you don't have a funded account or a trading account, you cannot be making money, and you will be missing out truly this time. So do not jump in driven by FOMO, because this might actually cause you real missed opportunities. Okay, guys, so take care of yourselves, and I hope I'll see you on the next one. If you have any questions, you know where to find me. Stay tuned and trade in. Bye-bye.